Call options, how do you buy them? How do you manage them? In this video, I want to quickly go over a video that I previously made and show you an example of a call option. I specifically want to show you a stock that I think is ready to break out. So this stock, if it breaks out, buying a call option could make a lot of money. So I'm going to go over the technical analysis. Then I'm also going to go into my Robinhood portfolio and then quickly look at a few examples. Okay, so let's watch this video real fast and let's make sure that we understand how to buy a call option properly, manage it, close it, and profit from it.
Selling call options. So first of all, an option is an agreement between two people. Buying a call option is betting on a stock rising. So a call option is just a contract that allows the buyer to purchase 100 shares of stock at the call option's strike price. So a call option is used to buy stock, specifically 100 shares. But what is a strike price? A strike price is the price which you are betting on the stock reaching, or in other words, a strike price is the price at which the option can be converted into shares of the stock if it is being exercised. And if it's above the strike price, you will be exercising because it makes a lot of sense. Exercise, besides sounding like we're going to be lifting some weights or jogging, refers to the action of converting the option contract into shares of the stock. Let me do an example on the whiteboard so you can see how this actually works visually, since we learn visually and I specifically learn with examples. All right, so I drew this example on the board right here. Basically, we have a stock which is $100, okay? And then we have a call option with a strike price of $110.
All right, so this is actually going to be very similar to the Amazon example because Amazon is currently at $110. So the call option I'm going to show you on Amazon is actually going to be basically the same, but we're probably going to go out to a $120 call option. And then we're going to actually have to be very careful about picking a correct expiration date, because if you pick an expiration date that's just like, 3 days out or, even 2 weeks out, that may not be enough time for the stock to have action. So when I'm buying call options, I do not like to buy short-term call options. I like to go out more in time so that more stuff can happen in between.
The reason we're buying call option is because we think that the stock is going to go above $110. So this stock, if it reaches above $110, gives us the opportunity, the right to actually buy the stock at $110. What happens below $110 is, well, we don't have the right. We're not going to actually exercise because we are not making money. At $110, we are at the money, or we're beginning to make money. So essentially, when a stock rises to 110 or above, the point of a call option is we buy the call option and we bet on this strike price.
All right, so let's actually set up a call option right now, because as we go through the video, I want to make sure that I'm setting up an example so you can see it on the whiteboard, and at the same time I can show you by actually opening up the position. So again, if you take a look at Amazon right now, Amazon has been a stock that was well over $140 per share, and recently it has had a major dip. I mean, this thing took the escalator down. I mean, kind of slowly, but at the same time very consistently just went down. It was a very bearish movement. Okay, and then the stock ended up bottoming out at around $86. It had some resistance here when it actually started to come back up to 100, but since then it has broke that resistance, and now we have established a long-term bullish trend. So when I look at Amazon, it's a clear bullish trend to me because, well, we had like a triple bottom. You see, it was at 86 here, and then again, it was kind of like another $81, $83, and then we have not seen that price, and that price was back in the beginning of the year, so about 5 months as I'm making this video. But if you're watching this video in the future, it's basically the same concept. You want to pick a stock that has a good momentum higher. Momentum is a very, very big deal. Like if I go to 3 months right now, and I click 3 months, which is basically 90 days, you can see how the momentum is very good. Now, what I learned on Wall Street was basically when a stock has positive momentum, you don't really want to bet against it. You want to be with the trend. Essentially, you want to ride this trend, okay? So currently it's at $110. And what I'm going to do is I'm actually going to set up a call option, okay? So I'm going to pick a future date. I'm going to pick an expiration date that is sometime in the future. I can go really short term, but again, like I said, when I'm buying options, which I don't do all the time, I'm much more of a fan of consistent passive income, which I have a video on in the description about selling put options. That's my personal favorite strategy. But here, if I'm going to be buying a call option, I at least want to have a few months, 90 days at the minimum. But here I'm going to pick a 126-day option, okay? And, the farther out I go, cool, the premium is becoming less. I mean, it's a lot cheaper, but at the same time, you need the stock to move a lot to make money, okay? So it doesn't always make sense to just go out super, super far. Now, if I go to the 1-year chart again, I just want to show you where I think the stock can go. I think it can go up to $120, right? Because right here we can see that this stock was 140, but let's not be super aggressive. Let's just say we think that the stock is going to be 120. Okay, it's currently at $110. Now, if you actually pick a call option like 120, you will see that the break even is pretty much a lot higher. It's at 125, and that's because the strike is 120, but there's also a premium of $5. So in this example, it wouldn't necessarily be profitable to buy a call option, but I have a strategy around this, and I can actually show you how you can take profits early. But let's continue to watch this video, and I'll get into that in just a moment.
Here's why this is important. Buying a stock that is $100 costs $100. Buying an option betting on a stock going to 110 may cost something like $2. So instead of spending $100, you can control 100 shares of stock by buying a call option that is like $2 or something very inexpensive. $2 versus $100, you have much more leverage and you control the same amount of shares. So Henry, you're telling me that I can control stock for just $2? Well, yes, essentially you can. Just one thing though, since each option represents 100 shares, if an option is worth $2, that really means it's worth $200. And since it is 100 shares, that means $200 can control $10,000 worth of money. Where am I getting $10,000 from? Well, 100 shares times $100 is $10,000.
Yes, so we just saw that right now with actually Amazon. If we end up buying, let's say 115 call option, we can control 100 shares, which is $11,500 for just about $745. So the biggest factor with the call option, the biggest benefit is that you get a whole lot of leverage. And again, you can close that option early. You don't have to hold it until expiration. Because what we see right here, even if I buy the 115, the break even is still 122 if you hold until the very last day of expiration. But in my opinion, it's much better to sell a call option for profit, not get greedy. And as soon as you see a decent profit, for me, 30-40%, I'm going to cut the position. I'm going to get into that again in more detail, but we have to finish this up.
So in this scenario, to have 100 shares of stock, it's $10,000. Here, to control 100 shares of stock, betting on it going to $110 is $200. That's literally a 50 difference. I mean, it's 50 times cheaper to be buying call options versus owning stocks outright. Of course, I will get into the negatives. There is some negatives and risks, but let's keep going here. So the main element about buying call options, which attracts so many people, is important to understand for you, is that one call option is always going to be less expensive than owning the equivalent of 100 shares of a stock, because call options are just always going to be cheaper and they're going to have leverage. They're going to allow you to control 100 shares for a lower price. Now, what we do have to talk about here is that there's going to be a premium on the option. Options are not free, so you don't get to just bet 110 strike without paying some type of premium. So we're going to go over an example of paying a premium, and we're actually going to pull up a real life example of Apple stock. We're going to be looking at Apple call options, and I'm going to show you exactly what a call option on Apple looks like versus just owning outright shares of Apple by itself without having the call option.
So yeah, what we're going to do is we're going to watch the Apple example and then get into the Amazon example, because both of these stocks are phenomenal for buying call options. I'm a huge fan of the information technology space because typically it has really positive and good momentum. These stocks are growth stocks, so if anything makes sense to buy a call option, it would be something that has more movement to it. And information technology is a really good example of that. So we're going to watch Apple, and then we're going to get into Amazon, which is a more recent example, whereas this is a little bit older of an example.
So check it out. I'm looking at my screen right now, and basically we have an Apple call option here. As you can see, it's a 120 strike, and we can pay $207 to buy basically the rights to 100 shares of the stock. I'm going to explain to you exactly what this means and what the break even is, because it's important to know what you're paying for and what your outcome is going to be. I'm going to explain that right now. So basically, if you're going to buy 100 shares of Apple stock right now, it's at $118.72 right now. So if you're gonna buy 100 shares, you're going to have to pay this amount right here, $118.72. And because we're buying 100 shares, we're gonna put 2 decimal points over. There we go. $11,872 is what you will have to do to buy Apple stock right now, 100 shares, okay? Now with the call
Or
option,
now.
we're gonna be betting at 120 strike, okay guys? And this costs, it costs right here, 200.
Really interesting because I'm also picking the 120 strike, and this is probably what I'm going to do with the Amazon example as well. And in all reality, if the market was open, I would probably do something like this. I don't love dumping a lot of money into buying positions, but from time to time I do. Like recently, I ended up buying Alibaba call options in my Discord community, and we actually ended up making about $400. I'm going to show you that as well, but again, I want to get through this example real fast because I want you to understand how buying call options really works, the whole fundamentals around it.
Notice here that it says break even of 122.07. The reason it's a break even is because we're adding the strike price, which is $120, plus our premium. So our break even is 122, okay? 122.07. Once the stock reaches this price right here, everything above it is yours. Call options have unlimited upside potential. They continue to go up because it's essentially similar to owning shares, but you have that initial break-even point where you have to pay a premium, plus you're betting on a strike price higher than the current strike price. Essentially, I can draw you guys a graph right now. All right, so essentially we have Apple, right? So let's say this is 118, okay? 118.72, okay? Here's Apple stock. It goes up and down, right? As the price here, this is the price, okay? We've made $0. If Apple goes up 10 bucks to this area right here, you earn 10 times 100, which is $1,000, okay? You can earn $1,000 when Apple goes to, this is going to be 128.72, okay? That's Apple stock. It's pretty simple, right? It goes up $1, you make $100 because you have 100 shares. Now let's talk about the call option. With the call option, we talked about having a strike price of $120. So we need to go to at least 120 to start making money. Now, we also have to pay $200, $207, but let's just call it $200, okay? With the call option, you start out right here. Right away, you're losing money because you have to pay a premium. So you're paying $200. You start out at negative 200. Notice that your maximum loss is negative $200. You cannot lose more than what you put into a call option. Okay, so here we have a call option. We spent negative $200. And regardless of how low the stock goes, you see a stock investor can go down all the way to negative $118 times 100 shares. You can lose 11 grand here, or over 11 grand. With a call option, you're stuck here. No matter how low you go, you're always at negative 200, okay? And your break even, again guys, it's the strike price plus the premium. So the strike price was 120, okay? And the premium was $2, okay? Our break even is 122. So somewhere here, okay, 122, call it here, is our break even price. What happens is between 120 and 122, it starts to go up. It starts to go towards break even. Boom, we have broken even. And now you have unlimited upside, just like the stockholder, and you're going up essentially one for one, okay? Here you are. So let's see what actually happens here is when a stock goes up $10, as a stock investor, you earn $1,000, okay? $1,000. As an option investor, when it goes up 10 bucks, okay? This right here, 128.72, we'll just call it 128. 128 minus 122, that is going to be $6, guys. So $6 you make, okay, I'm gonna draw it right here. You make $6 as an option investor and you make $10 as a stock investor, okay? So who made more money? Well, the stock investor made 10 bucks and the option investor made $6. But how much did the option investor invest? And by the way, since it's 100 shares, this is actually $600 and this is actually $1,000, okay? This is $1,000 and that's 600 because again, each option contract is worth 100 shares of stock. So, the stock investor made $1,000, but how much did he have to put in? He had to put in $11,000. How much did the option investor have to put in? He put in $200 and got $600. So you can triple your money as a call option buyer. You can absolutely triple your money. And even more, it can go unlimited. It can keep going. But essentially, I'm trying to paint you guys an example that buying calls, you have a little bit of an initial break-even price. It has to go up by the amount of premium that you pay plus the strike price. You can play around with the strike price. That's beyond the scope of this video. But essentially, a call option.
You know what? I will show you how to play around with the strike price. So basically, let's go back to this Amazon example, okay? So essentially what I want to do, and I'm going to show you how to take profit as well, because that's the most important thing. If you don't take profit properly and just wait until expiration, It could work, but also you have theta working against you. So let me explain, okay? So if I expand this option right here, you'll see like, first of all, the bid-ask spread is pretty good. It's pretty tight, okay? It's Amazon, so I would expect it to be tight and close. If it was very far apart, that would be bad because it's called an illiquid stock. And basically, if it's illiquid, then that's not really good. But here, the volume is very healthy. The open interest is very good. The implied volatility is not as high as I would like. I typically like to see 40, but that's for selling options. Here, because this is 33, it's actually a very good thing because as an option buyer, low implied volatility is actually good because you're getting a cheaper price, okay? But what I mean by theta is the current theta is 0.04, which means that basically every single day it's losing $4 of value, all things even. So if this stock stands still and does nothing, it's losing $4 a day. But as you get closer to expiration, it's going to start losing 5, 6, 10, $15 per day. So you basically want to have a play on this where you think a stock will rise, but you don't want to hold this option until expiration. So for example, this option expires in 126 days. What I would personally do is if the position or if Amazon goes up by 5%, this option can easily go up by 15 or 20% because there's a leverage factor, right? Options are leveraged, especially call options. You're putting up very little capital, and then these options are moving by a lot, right? I mean, they can easily move 3 or 4 or 5 times more than the stock itself. So say you're bullish on Amazon and ends up going up 5% in the short term. Well, this option is going to benefit by 15 or 20%. And in that scenario, I would actually end up closing this position because I don't think there's a point of holding this too long since theta will start to kick in and really eat away at your option.
Buy 100 shares of stock, you can leverage your money because you put in so little and you can get out so much. And this is a better way than just owning stock outright in many scenarios. However, we do have to talk about risks. I'm about to get into that right now. Okay, now that you have seen why call options can be so lucrative, I need to explain what expiration means. Expiration, like the old milk in your fridge, is when the contract expires. It is no longer valid. Either as a buyer, you made money or you lost what you paid for the option, which is called the premium, which I just mentioned. Now, the good news and a big benefit to the call buyer is that they can only lose what they paid in to the option. In the case of an Apple call option, as you can see on my screen, you can only lose $207. When you buy calls, your maximum loss is just a premium, whereas if you own 100 shares of Apple stock at the current price of $119, you can lose $11,900. Of course, Apple isn't likely to go to zero, but it was $70 on April 17th, 2020, literally this year, and that was just...
Again, it's an old example, but the same really applies right now. So if you're going to hold a call option, again, you want to profit as fast as possible because time is working against you. And then second of all, you want to pick a stock that has good momentum. So for Amazon at this very moment, this is a current example, Amazon is coming up, which means that it could be a good time to buy a call option. Whereas this old example, it's still very good because it's going to train you based on history. And history is very important. I never thought it was important, but it is for making more money.
And that was just 6 months ago, so you can lose thousands of dollars, in fact $3,900 to be exact if Apple falls back down to $70 per share as a stock investor. As an option investor, it's literally just $200. Now, because all options have a limited time frame and expire every Friday, at least for most stocks in the S&P 500, some stocks expire once a month, which is the third Friday of each month on less traded stocks. You have to be right about a stock's direction, and it has to happen before the expiration date due to a limited time on the option itself. We don't have the benefit of unlimited time frames just like we do with stocks. With options, you have to be right, and you have to be right within a certain time period, and that is one of the biggest risks.
All right, so I promised to tell you guys about Alibaba and a play that I just recently had. And as you can see here, I ended up buying Alibaba calls, and I did end up waiting a good amount of time, maybe like 2 weeks here, but I ended up buying for $33.50 and then selling for $37.50 right here. So it wasn't a huge profit, but as soon as I saw a profit eke out, I ended up closing this position right away and taking a $400 gain. So here's a question. Would you rather have double the amount of money that you have right now, but not be able to trade options, or be able to buy options, sell options, but you have half the money that you have right now in your portfolio?